in two parts. We start with an overview of the current state of the market across the GCC. This will be followed by trends in the food and beverage sector around cuisines, formats, consumer preferences, and importantly, delivery. At the end of each of these sessions, we will invite our panel of guest speakers for a discussion to share their views on specific topics. And at the end, we would have some time for questions from the audience. All the participants will be on mute throughout the duration of this session. So please type your questions in the Q&A tab on the right-hand side of your screen, and we'll do our best to answer as many as we can. The session is also being recorded, and you will receive the recording via email within 48 hours. After the session ends, you will be prompted to complete a short survey. Please take a few minutes to provide your thoughts to us. I would also like to point to some of the icons that you see on the screen to the right-hand side. You will find this as we present. The ones without mask refer to consumer or operator survey we conducted in 2019. And the masked ones refer to questions we asked consumers and operators during the month of June. At this stage, let me introduce our guest speakers for this session. We are delighted to have with us Amarpal Sandhu, CEO of the restaurant division at Americana. Americana currently has 23 restaurant chains across 13 countries and over 1,000 outlets. We are also pleased to have Basil Al-Salam, founder and CEO of Gastronomica. Gastronomica operates some of the successful high-end restaurants across GCC, Burger Boutique, Slider Station, and Cocoa Kitchen, to name a few. We also have with us Sajan Alex, Vice President, Restaurant Division for Tables Food Company, a subsidiary of the Lulu Group. Tables operates some of the popular F&B brands in the UAE, including Peppermills, Famous Dave's, Bloomsbury's, and Calitos. And last, but certainly not the least, we have Mohammed Balot, CEO and co-founder of Kitopi, a managed cloud kitchen concept that has taken the market by storm. Since 2018, Kitopi has grown across the GCC, powering more than 120 brands across more than 50 kitchens. Let me also take this opportunity to introduce my colleagues. Anurag Bajpai is a partner at KPMG, and he heads consumer and retail sector for the firm in the Lower Gulf. We also have with us Sonika Sahani, who is an associate director with KPMG's Global Strategy Group. What a ride it has been in 2020 for the F&B industry. Entering the new year, the first couple of months made many operators feel that the worst was behind them. After the challenging last few years, the like-for-like sales showed some promise, and it seemed the industry had started to turn the tide. And then the pandemic struck the GCC region. It would be fair to say the food and beverage sector has not seen more challenging times than this. And here we are today to talk about some of these challenges as well as opportunities and provide insights into shift in consumer behavior, all of these making the recipe for resilience for the future. This is our fifth F&B report and the first GCC report. For the purpose of this report, as mentioned earlier, we've conducted two consumer surveys. The first one in 2019 with 2,400 respondents, and the subsequent survey in June 2020 during the pandemic with 600 respondents. We also interviewed 35 stakeholders operating across the GCC, representing more than 170 brands and over 3,300 outlets. With this backdrop, I will now hand it over to Anurag, who will talk talk to us about the current state of the market and the impact of the current crisis on the sector in the region. Over to you, Anurag.
Thanks, Vikrant, for getting us started. Good morning, everyone. It's a delight to be with you here this morning. In usual times, we would have done this in a very different setting, but these are not normal times. For us, this report has been a true labor of love. The work on this report started 15 minutes back in the summer of last year. And earlier this year, when we were all set, or we thought we were all set and ready to release the report, COVID happened. And with like a lot of other things in the world, we had to course correct. We went back. We updated and rewrote certain sections of the report to just update it for what we were seeing happening in the market around us. So in the next hour or so, I will take you through some of the findings, and I emphasize on the word some of the key findings from our report. There are other findings that you can, Vikrant will share a link to the report at the end. You can download and have a look at it. What I will start off with is to look at some consumer trends and some trends on operator performance, and I will take you through a quick tour of the Gulf. So let's get started. So the region has established itself as a gastronomic hub. Cities like Dubai are global F&B destinations. We see a number of popular global brands, international chefs across different concepts. Dubai does, and the larger region does pretty well in terms of international tourist numbers. Dubai has one of the highest or pretty significant restaurant footprint, compares well with global destinations like New York and Singapore. This year, interestingly, we see Abu Dhabi making it to the top 10 of this MasterCard report that is referenced here as top 10 fastest growing destinations. So it's a market that is increasingly popular with the tourists, and people have high disposable incomes. Moving on. So as Vikrant mentioned, and on the slides from now on, you will see this. There are different icons. The icon on the left, the one without the mask, relates to or references a consumer survey we did in 2019, Q3 of 2019. The icon on the right is a survey we ran earlier this year in June during the height of the pandemic. So let's start with looking at consumer dining out habits, and we're comparing 2019 versus 2018. We looked at frequency and spend. The inner circle references frequency, the outer circle references spend. In the UAE, we've continued to see strong consumer demand. We've seen about 78% of the consumers eating out as often as they did in the previous years. We've seen spend to be consistently high at 83%, and we've seen this strong over the last number of years. So the consumer demand continues to be robust, continues to be strong. However, what we've also seen is over the last 6 months, we've seen COVID having an impact on consumer sentiment. After the lockdown and the restrictions, there were a number of consumers who wanted to restart the rhythm of their life and get back to life as normal. But there were a number of other consumers who were skeptical and cautious, and it took a while for them to get their confidence back. And we've seen that in the numbers here, and I'm referring to the graph on the right-hand side. We see, and this is a survey we ran in June, with consumers saying that they will only go back to their pre-COVID dining out habits over a gradual period of time. So by the end of the year, we expect 70% of the consumers to have recommenced or restarted their pre-COVID dining out habits. Now, again, there are other certainties involved, and with increasing and fluctuating COVID numbers, there have been lockdown in other parts of the world. So that again has something that influences and has an impact on consumer behavior going forward. Moving on our next slide, reflecting on what's been happening with operator performance. So 2019 was a good year for operators, especially the back end of 2019. And for a number of operators, we saw growth come back after a few challenging years. And when operators entered into 2020, they had a renewed optimism with regards to the business. Also, there was Expo on the horizon, and a lot of operators expected Expo to boost their business. However, then COVID happened, and this impacted the operators' business. Now, in terms of the short-term view of operators, a number of operators were skeptical and apprehensive about the impact COVID will have on a business. 9 out of 10 operators told us that they expect a more than 20% drop in the business in the next 12 months. 1/3 of the operators expected a greater than 40% like-for-like drop in the business over the next 12 months. In terms of medium-term outlook, the outlook became a little optimistic, and people were still expecting, majority of the operators were expecting growth over the medium term. And we say medium term, we refer to a horizon of 12 to 36 months. Expo is a significant event that will impact positively the fortunes of the sector. When we spoke to the operators last year, a lot of them, 7 out of 10 operators, were expecting Expo to have a beneficial or positive impact on the business going forward. And we expect that to happen when Expo takes place in a year's time. Moving on, let's, so on this slide, we look at the similarities or the differences between two big cities in the UAE, Dubai and Abu Dhabi. Dubai, by far, is the bigger F&B market, fueled by higher number of expatriate population, also the high tourist numbers that Dubai gets. And what happens in Dubai has a significant impact on the fortunes of the operators that operate across the UAE. But what we've also seen in the market is, while Dubai is the larger market, average ticket size and margins are better for operators than Abu Dhabi. So Abu Dhabi is a higher spend market, a higher margin market for operators. And again, this is a combination of demographics and also a combination of a lower cost base in Abu Dhabi. But success in Dubai is a lot more challenging given these factors for operators in Dubai. And but Dubai continues to be the #1 destination that a lot of operators want to be in or open their outlets. Moving on, now we'll look at Saudi, and again we first start looking at the Saudi consumer sentiment. Again, the consumer sentiment continues to be consistent, continues to be strong. We've seen consistent numbers both with frequency and with spend in Saudi Arabia. Saudi Arabia is also currently going through a major social transformation and liberalization drive. Vision 2030 puts a lot of emphasis on leisure and entertainment, and that is expected to have a positive impact on the F&B spend. Saudi Arabia also has the advantage of a young population, so young, tech savvy, and a growing population. Taste profiles in Saudi Arabia are evolving, and we see the consumers become more global as they get exposed to different cuisines. In terms of operator sentiment, again, like the way we've seen in Dubai, in terms of consumer sentiment, like the way we've seen in Dubai, we've seen consumers come back to the pre-COVID dining out habits cautiously. About 2/3 of the consumers expect to only restart or recommence their pre-COVID dining out habits by the end of the year. But again, when we talk to operators and we see the actual numbers over the last few months, we've seen a positive bounce back. We've seen some of the consumer demand has come back earlier than what a lot of operators were expecting. If you move on to the next page and look at operator performance and operator trends in Saudi Arabia, again, 2019 was a good year for operators in Saudi Arabia. A lot of them saw growth. Also, a lot of them were optimistic about their prospects in 2020. And again, this is pre-COVID. COVID changed a lot of the outlook. And when we look at this, and this is the graph on the left, 86% of the operators that we spoke to were expecting a decline. In their business, and a significant decline in the business over the next 12 months. They're looking at a 40 to 60% decline in their business. And maybe the fact that these questions were asked sometime in June or July to operators, and there was and the VAT, the new VAT regime of 15% came in around that time. I think that also added to some of the views of the operators here. On the ground, we've seen the demand in Saudi come back a lot stronger, and we've seen a number of operators pretty close to their pre-pandemic like-for-like sales numbers. In terms of medium-term growth outlook, Saudi continues to be the beacon or the frontier for a number of operators around the region. Strong medium-term growth outlook, with about 74% of the operators looking at growth, high growth to moderate growth over the next 12 to 36 months. Moving on, and we now look at Kuwait. Again, consistent messaging in terms of consumer spend and frequency, as we've seen in UAE and Saudi Arabia. Strong consumer demand. Kuwait was the initial gastronomic hub in the region. So Kuwait, we've seen a lot of homegrown concepts that have spread to the region and that have come from Kuwait. Eating out and socializing with friends over food continues to be an integral part of the social fabric in Kuwait. However, again, we've seen COVID having an impact on consumer eating out habits. What we also see is in terms of consumer trends, during the COVID, we've seen a pretty strong comeback with operator numbers, and a number of consumers have come back to their pre-COVID eating out habits in the last 3 or 4 months. Again, Kuwait has one of the most optimistic operator outlooks over the next 12 months. 50% of the operators that we spoke to in Kuwait are looking at growth over the next 12 months, which is surprising. So out of all the countries we looked at, a lot of countries were skeptical, but Kuwait continues to have the most positive outlook. And some of this is actually borne by the numbers that we've seen operators perform over the last few months. Pretty strong rebound and comeback in terms of consumer numbers. In the medium term, again, we've seen there is a good positive outlook for medium-term growth from the operators, and 50% of the operators are looking at growth over the medium term. However, given the size of the market, we don't see a lot of international concepts looking at Kuwait closely. It is a highly competitive market, and it suffers some of the same malices that impact UAE with increased competition and a lot of availability of supply. So again, we don't see a lot of operators looking at Kuwait in terms of penetration, at least for the next few years. Looking at Oman, again, Oman is one of the smallest or is the smallest F&B market in the region. Consistent trends on eating out from consumers. What we have seen with Oman over the last 12 to 24 months is a move towards value and price consciousness. We've seen increasingly consumers looking at QSR segment and cafes. So we've seen that as a very popular format or segment within the sector. What we've also seen with consumer behavior in Oman is, out of all the countries in the region, Oman has had the fastest comeback to pre-COVID behavior from the consumers. So a lot of consumers have come back to their pre-COVID dining out behavior, and this is faster than any other country in the region. In terms of operator performance, again, we've had a mixed view on Oman. Number of operators in the short term are skeptical about growth, 50%. But when it comes to medium term outlook, there is cautiousness and people are expecting some growth in the market, but again, single digit. one of the things that will have an impact on the F&B market in Oman over the next 12 to 24 months is the introduction of VAT. And like UAE, and like it happened in the UAE, we expect the implementation of VAT to have a negative short-term impact on the growth or the outlook of the sector in Oman. With this, we come to our next part of the presentation, where I will now get some of the industry experts on, and I'll request them if they could switch their cameras on. We've seen over the last 10, 12 minutes, we've seen some of the trends with consumer behavior and operator performance. I think this is a good point to get the industry experts to come in and share some of their views. So Amarpal, can I sort of request you, if you could switch your camera on? And I know you have presence in multiple markets in the region. How do you see the GCC market? Do you think GCC is one homogeneous market, or you see nuances or differences between the different countries you operate within the GCC?
So Anurag, while there is cultural closeness between GCC markets, the operating environment is vastly different, right? So if you look at Dubai, there is a lot of diversity in Dubai. Demand drivers are different, regulatory is different, consumer behaviors, palettes are different. So I would say there are more differences, subtle differences between the GCC markets, and understanding those is critical, for the operators. So we have tailored strategies for each market versus, painting GCC with one single brushstroke. Okay,
fair enough. No, I think that's a good answer. I think, Mohammed, maybe I'll also sort of call and get you and seek your views on this. And compared to Americana, you are a young company, in an expansion mode. You're looking at GCC as one area of growth. How do you see the similarities or differences between different countries within the GCC?
Yeah, thanks for hosting us today. So it depends on what lens you see this from. I do think what we see in common is online ordering is very high. We see that consumers in the past 12 months have been more accepting for virtual brands. I remember having a conversation with a leading QSR player in Saudi Arabia where they wanted to have 500-600 stores because consumers had to see the storefront. And I'm sure if I ask the same leader today, that's something that's less important, right? So virtual brands are on the rise and more accepted. I also think that across all three countries, when we were running a sensitivity analysis on discounts, there's actually a lot of similarities to how consumers react to discounts. On the flip side, I think labor dynamics are very different. I think attracting talent in Saudi Arabia on a kitchen level is very different to doing it in Dubai or Kuwait. Much more challenging in Saudi Arabia for sure. I think platform dynamics are different. I think there's more similarity between the UAE and UAE and Kuwait than what we see in Saudi Arabia. Saudi Arabia is much more fragmented, and it's a whole different approach to working with the platforms. And I think the major difference we see is on the language side. Right? So, what we tell our restaurant partners is always to make sure that Arabic is a focus in Saudi Arabia. Same in Kuwait, UAE. It's a much more, English is kind of the primary language to be directed to consumer.
Okay. No, I think thank you, and you make some very interesting points, and I think which reinforces what Amarpal just said earlier about while there are similarities, there are these nuances or differences within each market, and especially for you. And I know Vikrant will cover it in in his session about how we've seen the growth in delivery and how is that different amongst the different markets in the region. So that's a great point. Mr. Basil, I'm sort of I will get call on you here. Now you are a restaurant owner with presence across multiple countries in the region, and your concepts are fast casual and casual. What challenges are you currently facing as a restaurant owner, and where are you investing your time, effort, and money at this point in time in your business?
First of all, good morning, everyone. I think what's really a challenge today is the fast-paced changes in there are more driven by social media than they used to be 5 years and 10 years ago, where they see certain trends, and that's where the market kind of heads for the short term. And that puts a lot of pressure on operators, especially us, when we are looking at having to constantly innovate and constantly develop and give a facelift to what we do to be able to catch up with consumer preferences. These are challenges. I mean, we're spending a lot of money on the furniture, on the design, on setting up the whole restaurant, and then once you're done with that, you have a new trend coming up. So this is a challenge for us to keep up with trends generally, and I think this is a global trend. It's not a regional trend. Now, that being said, if we're looking at the GCC as one whole area with similarities, I think each market has its own dynamics in terms of demographics, in terms of consumer spending, in terms of even which nationalities have which preferences. And we see that, especially in Dubai, as it's a much multicultural city. You see the differences in preferences with nationalities. So coming to target a market as a whole is very difficult when you have that multiculturalism in place. When we're looking at a more homogeneous market, such as Kuwait or Saudi Arabia, it's very easy to look at what are the trends, what do the consumers want, because we can lump them together. We could not do that in Dubai. So segmentation in certain markets are required, and that means that we develop certain concepts or even filter the concepts that we operate in certain markets versus others.
Okay. No, I think, and you make a very interesting point with the customer engagement and how do you keep and these consumer trends that are always coming up, and that as an operator you need to keep pace with. Let me ask you a question that's linked to what Basil just said, and this is more about long-term implications. So what is the crisis teaching you about the implications on consumer behavior in the long term, and what does it mean for operator, right? And do you say that will you ever get back as an operator? Will you ever see the same trends that you were seeing pre-COVID, or you think the way we eat and the way we transact has changed permanently?
I'm a firm believer of the segment, Anurag, and I will never vouch in favor of things changing forever for the restaurant business. I mean, to be very honest, this is one of the most preferred entertainment option, isn't it? I mean, you go for a movie or a dining out or into another entertainment center. So dining out, restaurant visits, socializing is one of the most preferred socializing platform. It can never change. And if anybody is saying it is going to change in favor of dining at home, no, I can't believe that, because there is a functional and an emotional part of dining in or dining out in a restaurant. So home delivery will help you with the functional part. The food will come to you pre-packed, warm, hot, ready to eat in a box. But the whole emotional part is missed. So when you go into a restaurant, you've got both parts weaved together, the functional and the emotional part, with all other experience component taken care. Yes, our models will go through a change. Yes, we would really be cautious about our capital allocation. Like Mr. Basil said, we will sift through trends more accurately, segment concepts that are fit to a certain profile. We will try and expand our boundaries of operations. I mean, if we see home dining is going to be a trend, I would say, I just want to relate to what Akio Toyoda was recently saying of Tesla. Tesla has a great recipe saying that's going to be the world order, but we have the restaurant, the chef, and the food has been cooked already. So we already have that in place. So for us to expand in any direction, establishing our strength in home dining, takeout, dining in any direction. We have it all with us. It's just about a matter of time that we go back to the drawing table, re-strategize ourselves, and allocate a sufficient amount of capital for each segment that we want to be in or each channel that we want to strengthen ourselves.
Interesting. So, Amarpal, I know you have your largely presence from an Americana perspective is in the fast sort of casual segment, which is a little different from what segment Sajan and Tables look after. What are your views on this, and how do you see long-term consumer behavior being impacted by what is currently happening for your business?
So Anurag, just for clarity, majority of our footprint is in QSR, quick service restaurants or fast food. We also have TGI Fridays and some other proprietary brands in the casual dining space. There's a lot of uncertainty, what the future holds. So obviously, when the pandemic first hit, we were making decisions on a day-to-day basis, right? Based on the lockdowns, the changing environment, and the dynamics in the markets, we were reacting to that. I remember having a meeting on March the 14th. This is before the lockdown. So we had started tracking the pandemic at the beginning of the year or late, 2019, based on what happened in China and then what was going on in Italy, Spain. So we were tracking it very closely, and we had an offsite LT meeting on March 14th, I remember it vividly, at the Rove Hotel in downtown Dubai, where the entire LT was there, to come up with a plan for COVID. So plan A, plan B, plan C, different scenarios on how it would impact us and what the long-term implications of that would be. The impact is huge, and it is across the value chain. It is on your operating footprint, it's on consumption behaviors, health and safety, digital, whether it's your asset planning, your development, and I believe a lot of it is here to stay. Now, having said that, some of those things were already in the works. So consumer preferences for off-premise were already happening. The journey on digitizing your experience was already happening. Focus on health and safety, food quality, packaging. What COVID did is it accelerated everything. And organizations that were agile were able to deal with it better and were able to cope with it better. And I believe Americana was one of those, is one of those organizations which demonstrated great flexibility and adaptability, during this the 7 or 8 months of COVID so far. See, we were also fortunate that we had already invested in home delivery. We had our own infrastructure, own fleet, and we were already investing in our digital platforms. So on one side, we were driving extreme efficiency in the value chain. On the other side, we were very focused on improving the overall guest experience through digital, through off-premise, omni-channel ordering, whether it's car hops, whether it's curbside, click and collect, focusing on the drive-throughs. So I think that shift, which was already taking place, got accelerated. And some of those things, yes, uncertainty looms, but in terms of the consumption patterns, some of those are here to stay.
No, I think this is fascinating and pretty similar to the conversations we are having with our clients and contacts in the sector about the need to be agile and the fact that you need to maybe take tough decisions if you have to come out of this stronger on the other side. So I think that's fascinating. And with this, maybe we come to the end of our first phase of the guest or the industry input. Thank you all for your comments, but don't go too far. We'll call you back the next 10 minutes, 15 minutes for the next round. With this, I hand over to my colleague, Sonika, who will now take us through the next phase of our presentation about the findings from our report. Sonika, over to you.
Good morning, everyone, and thank you, Anurag. It's a pleasure to be with you all today. Now let's switch gears to talk about the trends in cuisines and formats across the region. The top consumer preferences in the UAE have remained largely consistent over the past few years, with Indian, Italian, and Lebanese cuisine ranking the highest. When we look at the other countries in the region, there is a clear preference for local or GCC and Lebanese cuisine in KSA, Kuwait, and Oman. In KSA, local or GCC is the most preferred cuisine, and this is not surprising, given that Saudi nationals make up around 69% of the total population. Looking at Kuwait and Oman, the top choices are Lebanese and local cuisine. Again, reflective of the population, where majority of the population includes locals and Arab expats who have shown a preference for home cuisines. The above trends are also reflective of the demographic profile of the respective countries. Now let's talk about the formats. What are the operators talking about in terms of the different concepts that are there in the market today? When looking at formats, we note that in 2019, QSR and fast casual have benefited from the value-seeking behavior of customers. Also, the growing dominance of the food delivery segment has also aided the growth of the QSR segment. Talking about cafes, operators say that the space is crowded. However, it still continues to be popular, particularly as it's backed by the young and affluent population in the region that perceives cafes to be trendy and social concepts. Talking about casual dining, yes, it has been impacted by two reasons. One is the shift towards the QSR segment, as well as an oversaturation. However, certain operators still managed to grow in 2019 by offering better value propositions. Talking about premium dining, yes, this format continues to be impacted, and there has been an impact both in terms of the number of covers as well as the average spend. However, there are some certain specialist or branding restaurants that have continued to perform well. We also note a growing shift towards the premium casual concept within this format. Now let's talk about what's happening in terms of the consumers' frequency of dining out. Pandemic or not, eating out remains an important part of the social fabric of the region. Within the region, the UAE boasts the most favorable statistics for both dining out and ordering in. As the figures here show on the screen, consumers in the UAE dine out around 6 times a month and orders in over 5 meals a month. While most other countries in the GCC compare well with the UAE in terms of dining out, they are still lagging behind on delivery. Kuwait comes the closest at just under 5 meals ordered in per month on an average. Prior to COVID-19, the growing dominance of food delivery was also evident in the frequency of delivery orders across the region. This is also supported by the demographic profile of the region, which has a large working population that seeks convenience and comfort to match its hectic lifestyle. Now let's look at some of the consumer spends on dining out and ordering in, as these have some interesting insights and trends. Consumers in all the GCC countries tend to spend more on dining out compared to ordering in. The UAE consumer tends to spend the highest on an average compared to other GCC countries. Kuwait's ordering in spends are also higher compared to the rest. On the other hand, we have consumers in Oman tend to spend less on an average when compared to the other countries in the region. And interestingly, the spend on delivery for the average customer in Oman is nearly half of their spend on eating out. Talking about the benchmarks that we have seen in 2019 across the various formats, when you look at the benchmark data, yes, the economics have been drastically impacted during the pandemic. However, these trends still remain relevant to the operators as business is expected to normalize in the coming months. In 2019, across formats, we have noticed a relative widening in the range of transactions, which is reflective of the market conditions. Having said that, the food costs were largely consistent year on year. Talking about rentals, yes, rental costs remain consistent in 2019 as and when compared to 2018. However, rental costs are a key concern for operators, and this holds true even in today's challenging market conditions in 2020. Even though revenue ranges generally widened in 2019, margins stayed the same or slightly declined for most formats. There were, however, exceptions in the casual and cafe concepts where some operators were able to perform better in 2019 compared to 2018. During the pandemic, the operators have taken a series of steps and measures in order to protect their margins and also to manage staff costs through various initiatives, be it unpaid leave, reduction in staff count, reduction in salaries, etc. These measures were also supported by the regional stakeholders in the F&B space, such as the government, landlords, etc. However, this short-term contraction in the market is expected to outweigh any benefits from these measures. Now, talking about the revenue per square feet, as you can see, QSR and fast casual, as well as premium dining, has the highest revenue per square feet. However, this is for differing reasons. In case of QSR, this is driven by the large volumes. However, in case of premium dining, this is a function or a result of having a higher average spend. With this, I would like to hand over to Vikrant, who has some interesting facts for us about a typical GCC consumer, as well as will present some facts upon the most interesting and talked about segment within food, which is delivery. Thank you, everyone.
Thank you, Sonika. Thank you so much. Before I proceed and talk about the GCC consumer, a quick request to the audience. Please keep posting your questions on the Q&A tab on the right-hand side. Please keep them coming. Now, having looked at the cuisines and the formats and what's been happening to the operators' P&L, let's look at what the typical GCC F&B consumer looks like. So the typical consumer is a deal seeker. Around 80% of the consumers are encouraged by deals. At the same time, over 70% of these consumers do not value loyalty programs. Now, we know that a lot of operators have either moved away or have been intending to move away from deals to a more sticky loyalty program-based approach. This is an important message from the consumer that unless they see tangible benefits, it would be difficult to drive consumer loyalty and sway them away from deals. The average consumer also continues to be swayed by word of mouth, which continues to be a big influence. Also, the consumer today is increasingly more health conscious, with over 50% of the consumers looking to eat healthily. As Sonika has mentioned, let's look at what's been happening around food delivery. Delivery, as we have seen in the past few years, has been a bright spot for most operators. In 2019, 2/3 of the operators witnessed growth in their delivery business. Further, for 22% of these operators, the share of delivery was more than 1/4 of their total revenue. Even during the pandemic, for over 65% of the operators, the delivery business either grew or remained at the same level as in 2019. That said, operators have also voiced concerns regarding the limited impact of delivery on their bottom line, The commissions to the aggregators, which are for 80% of the operators that we spoke to, it ranges from 15 to 25%. Listing fees, deals, promotions, and many other charges, they all add up to the cost of delivery, which does not help the profitability. On the aggregators part, the costs have been increasing with increased competition. The customer acquisition cost for them has been increasing, and this limits their ability to offer concessions to the operators. But that said, while there is no immediate solution for this, this is certainly a challenge that operators and aggregators will need to address. The other challenge from delivery perspective has been around the shift in consumer preference towards delivery during the pandemic. When we surveyed the consumers during the summers, nearly 60% of the consumers said that they would either reduce ordering in or they would stop it altogether. The key concern from the consumer's perspective, understandably, was around hygiene factor, whether it was at the outlet level or the delivery itself. So not surprising, some of these concerns today have subsided in the last few months, but many operators, tell us, that demand has peaked, but there is more that they can expect, or they are hoping to expect from consumers around delivery. And this brings us to the other major pocket of growth in the market, which is around delivery kitchens. This is a space we have been tracking since 2018, and we've seen shift towards and a strong growth in delivery-only kitchens in the recent times. Based on operators' feedback itself, and this was pre-pandemic, 7 out of 10 operators said that they see potential in this space, and over 50% either already had the presence or were looking to have one. We expect many operators to gravitate towards this during the pandemic, and though the choice of the model could vary, and we have different models that do exist in this space, from having a dark kitchen for physical store brands, to cloud kitchen for virtual brands, to even rental-based, multi-brand cloud kitchen models, and finally the managed kitchens. As with the case of aggregators a few years ago, this is definitely a space to watch out for, according to us, in the coming years, as the F&B business model itself is going to transform. Another often talked about aspect of F&B business, and something that we touched upon a short while ago, is around loyalty programs. As mentioned earlier, we see contrasting views from operators as well as and consumers when it comes to F&B specific loyalty programs. Well, 75% of the operators that we spoke to saw value in loyalty programs, and some of this is driven by operators' desire to move the consumer away from deal-based engagement. However, when we spoke to the consumer, only 7 to 17% of the consumers regularly use such loyalty programs, with UAE at the higher end of the range and Oman and Kuwait on the lower side. Now, does this mean that there's no value in such programs? Definitely not. But there is definitely a significant gap in the way it is currently leveraged. In contrast to the 17% usage of the F&B specific loyalty programs, around 39% of the UAE consumers regularly use other loyalty programs. This is according to KPMG's 2019 Consumer Loyalty Report. The same report also indicates that loyalty can be a very powerful and effective tool, as 89% of loyal consumers will recommend a brand and 46% will give a brand a second chance after a bad experience. So in our view, operators certainly need to get better at driving the consumer engagement and the program usage as they develop their strategy for business turnaround. Well, with this, we come to the end of our presentation, and I would like to leave you with some key takeaways from our report. The F&B market in the GCC today presents a mix of opportunities and headwinds. Delivery has certainly grown, but there is a need for stakeholder alignment towards a more sustainable model. And delivery's kitchen is a space to watch out for. Deals will continue to influence consumers, and shift towards loyalty program will require more robust planning. QSR and fast casual continue to shine as other formats have largely been impacted. UAE and Kuwait consumers are the big spenders for dining out and delivery respectively. And lastly, I might be stating the obvious, but pandemic has certainly hurt the F&B business. I must also add here, and something that Anurag had initially mentioned, that we have only shared some of the highlights from the report today in our presentation. There is a lot more in the report, which you can download from KPMG's portal, and we will share the URL with you shortly. I will now like to invite our guest speakers for another round of discussion. So Amarpal, Pasil, Sajan, and Mohammed, can you please join us again? Right. So, Basil, let me start with you. We talked about the economics of the business a short while ago, Sonika mentioned. So how has the COVID restrictions really impacted the economics, the business economics, and how you're managing your cash flows and profitability for the business today?
Well, this is obviously a very challenging time for all operators. There's definitely lockdowns to deal with. There's health aspects or safety aspects to deal with as well. Let alone that consumers are a bit, if you're talking about dining, they're a bit afraid to go out and enjoy the same way that they used to pre-COVID. We see this as a temporary situation. We just don't know how long it will take. There is some positive news today with the development of a vaccine. So we can see that this situation can reverse partially over the next 6 months to a year. We don't know how long it will take for the rollout of the vaccine, but this is definitely a positive aspect. Now, that being said, how we managed our cash flows, and I think each operator had its own strategy to manage their cash flows, whether renegotiating leases to renegotiating salaries, whether deferment plans, etc. They all help in managing the cash flows during this very hard situation. On the other hand, is to look at where we can utilize the resources that we have to drive the business forward. So the first thing that we've done, and I still remember this, I was in Vietnam at the end of January when the COVID hit in China, and I saw this to be quite something that needs to be dealt with as it will expand and kind of hit the rest of the global economy. So we worked on a contingency plan that we put in certain phases, phase 1, phase 2, phase 3, of what do we do when this hits and how do we deal with it. We haven't really kind of foreseen the whole impact. I don't think anyone has kind of expected this to be more of a global pandemic. But that being said, we wanted to be more agile and provide solutions. So the first thing that we've done, the moment that we heard that the lockdown was coming in, is to develop home kits. So we know that this is the only thing that we could use other than cooked foods through delivery platforms, is to provide home kits where more people are going to be using that to cook at home. And we utilized all of our kitchens that were affected by the lockdowns as well and converted them into dark kitchens and used all of our concepts from the same kitchen. So, one kitchen would have 2 to 3 concepts, one would have 4, one would have 1. Really depends on the size of the kitchens. But what we've done is maximize the use of our facilities and resources to be able to get some revenue during COVID. And that has helped us a lot. Being a first mover advantage, I think we were the first to do that in Kuwait. as a restaurant operator to develop home kits. We were able to do that within a period of a week, which is very commendable from our team. And we had the resources to do it. And that gave us an advantage over the rest of the market, as everyone was looking from some sort of an experience of a restaurant during lockdown. And they started ordering those home kits. So that kind of helped us from the revenue side. On the cost side, we had to start renegotiating everything that we had in terms of supplier contracts to leases, to job contracts, et cetera, et cetera. And now that the lockdowns are eased, we're back to business to a certain degree. We're still affected, however, by this whole COVID situation, but we have managed to stay cash flow positive, which I think this is the most important aspect today, is to be above your expenses and cash flows are intact. And I think, once the situation improves over the next few months, we're going to be back in business as we used to be in 2019.
Yeah, thank you. And clearly, I mean, this is, as you said, a temporary situation. Things should improve from here onwards. Amarpal, let me move the spotlight to you and ask you about, one of the things that I touched upon was around operators' concern, which consistently revolve around aggregator commissions. So do you see potential for improvement in operator-aggregator alignment? And how do you see this happening?
So Vikrant, it's all about striking the right balance, right? So I think it's important that, so first of all, aggregators and restaurant operators have to coexist, right? The consumers will drive those choices. But in terms of the relationships, the partnerships, it's very important that there is balance and alignment on strategic priorities as well as the commercial terms. So given that we operate very large brands across GCC and North Africa, we have a lot of relationships with the different aggregators. And so far, we've been able to strike that balance. So it's important that the aggregators understand their space and what the lines are, and similarly, the restaurant operators as well. We are the owners and operators of brands. The customer data should be shared. The experience to the guest, we play a big role in that, because we see the aggregators as virtual landlords. So take, for example, a Dubai mall. There's real estate, and there are many different brands that are operating out of Dubai mall. So similar to that, the aggregator marketplace is also a virtual mall, and we are renting space on their portals to provide services from our brands, our food, to the customers. So striking that balance is important, and if there is misalignment on strategy or commercial terms, then we are prepared to walk away from those relationships as well, and we've done that, and we will continue to do that. So yes, there is room for coexistence. We will continue to navigate through that from both sides. It's important that the aggregators bring in complementary value, both strategically and commercially, to our enterprises. And if we can do that, then it's a win-win situation.
No, great. Definitely. And I think it's important to find that balance. And that's where I think the struggle has been for a lot of operators and the aggregators. Let me now ask Mohammed around, and we've been talking about cloud kitchens, how this is the talk of the town. And even during the pandemic, cloud kitchens have done so well. So Mohammed, according to you, from the different cloud kitchen models that exist today, which ones do you think will prevail and succeed, and why? What's your view around that?
So I think I might be a little biased here, since I'm only operating in one part of that vertical.
Sure.
maybe I can just describe our lens on how we see the entire space evolving. So initially, it started off being similar to WeWork, a rental space where people came in, leased out space from the cloud kitchens, and that was solving the real estate problem. I think in the GCC in particular, we don't believe that's a problem. The rental, there is no supply issues when it comes down to fully fitted out kitchens. So I don't think that's really solving the problem. I think that's one vertical, which is the real estate side. The other part of the cloud kitchen space was people building virtual brands, which we believe is here to stay. We think that consumers are appreciating a variety of brands even more, and I think that all operators are building their own virtual brands, and it's helping them manage their bottom line more efficiently. From the same kitchen, you can produce so many more brands. And then the third part, which we play in, is the managed kitchen approach, which in essence is what Amar does in Americana. It's what we're trying to do as well in the virtual space, which is franchising, right? So we franchise the right to use the delivery arm of brands out, and we operate on their behalf using their standards across all the markets we're in. So you can be a brand in Kuwait, you want to move to Dubai, you want to be a brand in New York, you want to move to Saudi Arabia. You license your brand out to us or to anyone doing exactly what we do, and it allows them to scale up significantly faster as long as they have the right partner operating on their behalf. So to answer your question, I do think that the managed kitchen approach, in our view, is the winning approach, because everything else seems to be unsustainable. We haven't seen or come across any restaurant operator who can still make a profit when you're 100% delivery working with a cloud kitchen. So that hasn't yet been proven.
Right. On that note, Mohammed, also, do you see potential for some of these virtual brands that do not have physical presence in the market? Do you see them becoming direct competition for F&B operators in terms of setting up shops eventually? Do you see that happening, or do you see them still remaining on cloud?
So I think the purpose of building a virtual brand is to focus it on delivery only. So it's focused on the consumer who wants a product delivered to their house. And so operators are building brands that allow them to tailor make from a menu perspective. They create the menu that allows it to move to be transported in 30 minutes and still taste the same. So do I think it's moving? If you look at other e-commerce verticals, fashion is one. Tom's, Allbirds are really well-known brands in the US of shoes, and they were purely virtual, and then they had a physical store as well. And I do see it happening across other e-commerce verticals. So I do see that day is coming, but I do see it as not something that would compete with operators, but rather complement their offerings. I do think that an operator who has a physical brick and mortar store, and out of that same store has 2 or 3 virtual brands, might realize that 1 or 2 of these new virtual brands might have legs, and they can build its own physical store.
Great. And on that note, let me also ask this question to Sajan and very quickly get his comments on this. Sajan, you have a few virtual brands. Do you have plans to take them physical eventually?
Yeah, I mean, Vikrant, the intention to start the virtual brands was obviously to leverage our existing assets. The fixed cost, the capital is invested, the fixed cost is incurred. Can we increase the productivity on the same infrastructure, improve our top line? That was the initial intention. But we also realized that one is that this also gives kind of a test data. I mean, virtual brands out of these kitchens produce great numbers, and customers kind of lapped it up. So this is actually a validation of that model is working. Now we are a premium casual dining restaurant operator, which is kind of mostly affected during this time, and we kind of stuck in the middle space. And we realized we need to build resilience for shocks like this. And shocks like this, what happens is the propensity to save outruns propensity to spend. So people will downtrade. So how do we build resilience? Maybe take some of these virtual brands to physical space and be around in the QSR fast casual space. So that helps us to build resilience and withstand shocks. So we definitely are considering. We did evaluate multiple locations. It'll come because we have the test data. That's the whole point. I mean, we were able to test it. It was successful. We tweaked it. The model is ready. So there is a customer value proposition that is proven, and there is a profit model that is proven. So we just need to get the space and the process and people to put together and go live. So it's doable. Like I said, we are not talking about a recipe that will be proven. We're already cooking and serving. So for us, it's easy to sort of expand our boundary. I mean, you're looking at new buyer groups officially, of course. That's our intention. Look at new buyer groups instead of fighting a bloody battle that everybody loses. Look at new buyer groups. So this is the way we would get into new buyer groups. That's our plan.
Right. Thank you, Sarjan. So that's again quite interesting. And once again, gentlemen, thank you for this engaging discussion. Some really good insights coming out of this. I will now open the virtual floor to questions from the audience. And if you've not already done so, please write down your question on the right-hand side in the Q&A tab. And let me start by picking some of the questions that have already come in. So, Basil, a question from the audience for you around what would be your advice for SME F&B companies who want to expand their concepts in the post-COVID era? What would be your advice to them? Since you've done it successfully.
Yes, I mean, I think if we're looking at it today with COVID still a situation that we do not know how long this will take, whether it's a year or two, I would not be spending time on looking at expansion rather than looking at how we can build an agility in the business and more efficiency in the business. Basically becoming more ready for expansion. And this is kind of required. From here till a year or 2 years, we're going to be seeing differences or changes in consumer preferences. There's going to be changes in consumer spending. Any plans that are kept or that are worked on today might not be valid in 6 months' time. So we're still in very turbulent times today. We wouldn't be putting plans. If we had plans in 2019, fine. These are plans that have already been developed. But as we're looking at the situation today, whether from a COVID situation to an economic situation, if we're looking at the region, we're looking at an economic situation that is apart from COVID that needs to be dealt with. And the repercussions of such issues are yet to be seen. We haven't seen it yet, but we will see it in the next 2 to 3 years. So to have a plan of expansion today, I would be more cautious about and not be more worried about expansion, but be worried about being more efficient and being more agile as a business.
Certainly cautious, and caution is really the word where we stand today, but certainly with some optimism. Amarpal, a question from the audience for you. Let me sort of get your views around this. Has the market become more price conscious, more price sensitive with COVID, or are consumers spending more on better quality and healthier food? What's your view? What have you seen?
See, value has always been a mainstay for QSR. Quintessentially, I mean, the affordability is key. However, COVID has redefined value. And it's, in the past, value in QSR used to be strongly associated with low price points. But now it's about the overall experience. It's about health and safety. It's about digital, contactless, great quality food, good packaging, courteous employees. So I believe the consumers have become more discerning and more demanding. And there's a lot more brands have also elevated the experiences through the pandemic. The level of innovation around digital, around convenience, around value, around off-premise that has happened over the last 7 months is extraordinary. We probably compressed what would have happened in 5 years into 7 months. So to answer your question, value is being redefined, and it's more about the overall experience rather than just the price point.
No, we kind of agree with that, and that's what we've seen, at least from the consumer feedback as well around this. Sarjan, a question for you around home dining. Now, interestingly, home dining is a trend that COVID seems to have accelerated. So the question really is this expected to continue post-COVID? And while we don't know what is post-COVID reality, but do you see this trend continuing in the future?
Vikrant, home dining always existed. That was just a matter of convenience. It was never about an experience. So from a convenience perspective, it would continue to be relevant. Is that going to eat into all of the dining sales in the physical restaurants business? No, it is not. Because as I mentioned earlier, home dining space, that serves a functional need, pre-packed food. If you look at your own survey, 47% of home delivery sales that happened, or the 47% home delivery sale that was happening in Dubai, or whatever that number was, look at the transaction value. It was about under $14, right? Under $14, what you get is a box of comfort food, pre-packed food. That never delivers any other emotional or any other experiential component. So, yes, in that space, yes, it will continue to be relevant for the convenience per se, but otherwise, it is not going to be the world order of the day. It is going to be a coexistence. Yes, we as physical restaurant operators would also need to be learning from what has happened in last couple of years with the technology proliferation in the food industry. A lot of food entrepreneurs just grew overnight without owning any value chain. The entire value chain still lies with an operator like us who build the restaurant and cook the food and pack it and give it to a driver. So the whole value chain is still with us. The industry will not exist and will not continue to grow without quality operators running restaurants and producing quality food. So it's a coexistence. So if one side believes they can continue to monetize the other side, which is the operators, purely by showing a theory and a model which is not really proven, it's a false pass. It cannot be, because we are the most important cog in this whole value chain. If others have to replicate this, that's years of effort. And I'm sure Mr. Basil will agree, he probably would have put 2 decades time on building his restaurant business, and he's not going to surrender overnight. We are also agile. We will adapt. We will build our own capabilities to serve in the same space. So is there a huge entry barrier for us operators to get in that space and serve that space? No, absolutely no entry barriers. We just need to put some capital allocation, build an infrastructure, build a fleet, make the menu available. Here we go, and spend some money on the marketing. So it is going to be a coexistence. Some win, some lose, some compromises here and there, but it's not going to be one way.
Great. No, thanks a lot, Sarjan. Thanks for that. I think we have a lot more questions, but sadly, I think we've overrun on time, so we would need to wrap up the session. And we are coming to the end of our time here. My key takeaways from today's session is, as Mr. Basil had mentioned, this is about cautious optimism. So they are near-term challenges, but the medium-term outlook definitely still looks positive. And there is a need for operators to seriously rethink their business model to adjust to the new normal, because some of the shifts that we are seeing today, particularly from consumer perspective, could be permanent. But I would also like to conclude by drawing some of the positives from the recent trends. Anurag mentioned about how markets such as Saudi and Kuwait have shown good recovery in the recent months. And even for operators in UAE, since August, many of them have seen like-for-like monthly trends improve. And we continue to look optimistically at the expo. And of course, delivery kitchens is a big positive going forward. And finally, the announcement from Pfizer a couple of days ago could actually mean that the economies would be back on track sooner than expected. So we hope that the sector will come out stronger and better on the other side of the pandemic. And with that note, I would like to conclude by again thanking our panel of guest speakers, Amarpal, Basel, Sajan, and Mohammed, for being part of today's session and making us all richer from their experiences. I would also take this opportunity to thank all the operators and industry stakeholders who have provided us with their valuable inputs during our long journey for this report. And finally, a big thank you to all of you as attendees for spending your time with us and for making it an engaging session with your questions. I do sincerely hope that you found this to be a useful investment of your time. Please complete the short survey after this session. And thank you and stay safe.